Welcome to the Drill Down, in-depth answers to oilfield questions. I'm John Spears.
And I'm Richard Spears, and I'm wondering, where were we?
Where were we? Well, like I said, in-depth answers to oilfield questions. What's the question that you get asked the most these days, Rich?
I was standing up on a stage in Galveston, Texas last week at an SPE Artificial Lift Forum. And I said, I got to the point, anybody had any questions? And the guy holds up his hand, he says, all right, here's my question. What the hell happened to the drill down?
Yeah, so I think we owe folks something of an explanation. So, I know what my reason was.
But I'm going, we gave people back 15 minutes of their life every week.
That's true. Yeah.
By not doing it. But now you tell the customers why.
My reason, supply chain problems is what it is. Yeah. So I don't want to get into it in case I have to testify, but let's just say that someone who was expecting something didn't get it. And now someone who isn't expecting something is gonna get it. So
exactly.
And I just had to, get out of the country long enough to let the dust settle. So
plus, also one of the major components we use in our podcast is cobalt.
Yep,
and it was super hard to get cobalt. But
yeah, so that's a reason. But like what you said, you have
the people who were threatening us are now dead. And we can be back in the same room again.
I like to think of it, that if Tom Cruise can take 35 years to go from Top Gun to Top Gun Maverick, what's to stop us, right, from coming back, making it all happen? Although, he had a lot of success. I'm afraid we might end up more like Grease 2 or God forbid, Weekend at Bernie's Part 3. I mean, that would be bad. So
The Godfather Part 2 is better than Godfather Part 1.
So there's hope.
Maybe this is we're okay.
There's always hope, but
But we were not idle. In fact, business has been very good, and we've been busy. We're back on the road again. But one of the things that we've spent the last podcast was in December of 2021.
Yes.
This is September of 2022. That's 9 months. You could have given birth in that amount of time.
5 years. Yeah.
And but the world has been changing, and we were concerned that we didn't, even though we got gray hair. Yeah. We didn't want to be guilty of trying to make the industry behave in a way that it used to behave.
Explain it in 1980s terms. That's exactly right. You think about taking some time away to reflect, draw inspiration. The Beatles went to India. Elvis went to Las Vegas. But so you get, I think that's right. And it's very worthwhile, because my conclusion from sort of taking a little time and thinking about things is that as an industry, and for the operators and for service companies, equipment manufacturers alike, that this is not finished. We're in the process of transitioning to a different kind of industry than what it has been at any point in our past careers.
When many people hear the word transition,
these days, no.
What we're specifically talking about is the oil industry itself behaved one way, and now the oil industry itself is behaving another way. And that way is different.
Absolutely. We just got finished putting together a forecast, an update to our drilling forecast. And as I went through that exercise, to me, it was revealing how less important it was to think about the specific price of oil in establishing activity levels for next year. Because in the past, it was all about where's oil going and what's the price of gas going to be.
If you back up 10 years ago, 20 years ago, it was all about what's the price of gas.
Yeah, absolutely right. Yeah, so it was all commodity price driven.
But it's not that way
now.
And
this time around, I think just revealing to me that as I began to think, well, what's an important decision point? How do we think about, what are going to be the drivers? Commodity prices are out there still, but it's not nearly that. And so then you sort of take a step back from that and say, well, what are these new drivers and sort of what's their rank order? So I would like to think that that what we can do in Drill Down 2.0 is begin to address some of these changes that we see happening and are still going to unfold over the next, 5 years, 10 years, something like that.
So we had 1 million or more downloads of our podcast, Drill Down 1.0.
Are you okay?
So if you listen to those, just forget them.
We apologize.
Do anyway. Well, but that was indeed the olden days. And one of the things, so what we're actually going to do today is we're going to talk about 3 of the LinkedIn posts that I've made in the last couple of weeks. that have gotten the loudest or the most broad response.
Engagement, as it were. Yeah. And so you should pay attention. If you're not on LinkedIn, you certainly should, if only so that you can pick up the weekly posts that you put up there that sort of highlight some of these things. So let's pick 3 hot topics and bring them to folks' attention.
Well, so and because we spent the last 9 months looking at the transition of the oil industry, the way it was to the way it is now, the very first topic is a post that I made a couple of weeks ago where I said, is there a quick and dirty way to value an oil field service company by looking at its revenues?
Yes. So you constructed a ratio that was the price of the stock by the revenue of the...
not think about it as the price of the stock. What's the entire value?
The value of the company.
Price times number of shares outstanding.
Yeah. Divided by revenue. So you had a price to, what I think of as a price to sales ratio.
It was actually the other way around. It was revenues divided by the whole value of the company.
Okay, excellent.
And I said, so that would tell me what is the value of a company per dollar of that revenue.
Okay, gotcha.
And I picked 3 companies, large, medium, and small. They're all public.
Okay.
So you can track this stuff over time.
Sure.
And the 3 companies for large, large was Halliburton, medium was Patterson UTI, and small was ProPetro. All public.
Yeah.
So I got Halliburton.
Not just large, but also more focused as you go down that list. Yeah.
That's right.
One segment.
ProPetro, pretty much a frac company. Halliburton, global technology company.
Gotcha. Okay.
Patterson, very much a domestic company that does many things and has a very large market
share.
So
I know you did for more companies than that, but what was the conclusion? What jumped out at you?
If you look at the first quarter of 2019, so the old days.
The old days from an activity standpoint, but more importantly, I would say from the way the investor community thought about oil service companies.
That matters so much. But if you looked at each of those companies, Halliburton, Patterson, and ProPetro, $1 of revenue at each company was valued at, get this, $1 of market value.
So really,
they were all the same.
Yeah. Okay.
There was no distinction in the investor community between West Texas focused frac company ProPetro and global oil field service company. I got 20 things I do really well, and I'm the number 1 market leader in many of them. Halliburton.
Yeah. Now there is the bit about how's the balance sheet structured. So there's those kind of capital.
There's 100 things that go into a real valuation of a company.
Gotcha. Okay, gotcha.
But we're looking at the quick and dirty way.
Okay, so that was 2019.
Q1 of 2019. That ratio, that relationship of not $1, but investors viewed them all the same way. The value ebbed and flowed. Until the first quarter of, get this, 2021.
So we went through the pandemic year, right? Yeah.
All the values collapsed. $1 of revenue at each one of these companies became worth 40 cents of company value.
Yeah, I gotcha.
Then it grew through COVID to be worth $1.40 per dollar.
Oh, get out of here, right? Okay.
So
better than whatever. Okay.
Yeah. But after that point, they separated. And now here's the difference.
Okay.
Halliburton's $1 of revenue is worth $1.50.
Okay.
Patterson's $1 of revenue is worth $1.20.
Okay.
ProPetro is worth 60 cents.
So the investor community, for whatever reasons, has begun to differentiate between companies. It also differentiates from what it was valuing back 4 years ago, right? So interesting. Yes.
So there's been a change, but I think what this tells us is that for an investor to put $1 to work in a company, they'd far rather back and therefore value higher $1 of revenue associated with big global multiple product line technology.
So that story is even more important, salient today than it was 4 years ago. And so absolutely that. But that's also interesting because we've talked about how in the new investment environment that oil companies and oil service companies are going to have to kind of think of themselves as cigarette companies. They're sort of out of favor with a lot of investors who are ESG driven. And so they need to really step up their game when it comes to financial returns. And if that were the case, then these valuations would recover. And in fact, some have. So, yeah.
Yeah, I mean,
and so I think that story, has legs. We'll just have to keep an eye on how it goes from this point forward.
So 34,000 people interacted with that particular posting on LinkedIn.
Okay. What was the next one?
72,000 people and 400 people with comments responded to my post about Dawson Geophysical. Now, why did I pick Dawson Geophysical?
Why did you pick Dawson Geophysical?
They are a company headquartered in the Midland, Odessa area.
Yes.
They're public. You can look them up. That thumps on the ground.
Onshore geophysical surveys.
Seismic acquisition of data.
Yep, gotcha.
And if you
very much North America focused.
Very much U.S. land focused.
Okay.
And if you look at their revenues,
yep.
So this is the company that's probably the market leader.
This, yeah.
2016, was that a good year or bad year in the oil field?
Well, it was a recovery.
Year.
It was a recovery. 2015 was terrible. 2016 was bad too.
It was bad. But even during 2016, Dawson Geophysical had revenues. Yeah. So they were hired by oil companies to thump on the ground of $160 million.
Good. I thought you were going to ask me.
No, I've actually got it here. Okay. If you're looking online,
2016. What are they today?
Well, during COVID. Yeah. I think it matters. COVID was a crappy year. Everybody would have stopped, right? Yeah. During 2020, they still had about $100 million of work thumping on the ground on behalf of people during COVID.
160, 100. Okay.
All right. Last year.
Yeah.
25 million.
Ooh.
And the point that I made during this was this is one indicator of what the oil and gas industry is spending on itself. And geophysical has always been that indicator that says I can thump on the ground and look for new hydrocarbons.
Oh, that's what you do. Yeah, absolutely. Right.
Or I can define what I've got.
Yeah.
And 72,000 people look because my point was oil companies have, if this is the one piece of evidence we're going to use, they've quit exploring for or looking for new hydrocarbons and instead are drilling what they know they've got.
Yeah.
I stuck my neck out and said 8 years. In 8 years, they run out of places.
Well, that does raise the question: if they don't need it now, when might they need it going forward? Yeah. So there's a point in time where, hey, we've drilled all the prospects we had, and we backlogged whatever, and but we just aren't doing that now. And so that speaks again to the behavior change, or in the U.S. anyway, the oil companies.
I had a handful of people who disagreed with my conclusion. They said because of technology and science and computers, we no longer need to spend a nickel on trying to acquire more seismic data. Most people agreed with my conclusion, but a handful said because of science, we have all the data we need and we can go from there. And so your conclusion, Richard, is wrong. Gee, that's never happened where anybody's disagreed with my conclusion. But the big point is, a company that's a big oil company. Yes. They say, well, look, we can go buy our neighbor, and now we get all their properties, which they've underdeveloped. So, we're able to always expand our lease holding. And our argument is, but now the company who just bought that's zero now. Yeah,
the net effect on the industry is nothing.
Net effect is a decline.
Good point there. So we'll have to keep an eye on that. 8 years from now, we'll come back and talk about Dawson. So
so 47,000 people, and this will be the last one we do.
Okay.
47,000 people responded to a very simple chart that I created. Yes. Which was, what is the quarterly revenue per drilling rig over time? An active drilling rig in the U.S.
Okay.
What's its quarterly revenue during over time?
So it's revenue divided by active rig count. You take an active rig. Not just
Versus what's the quarterly revenue per frac spread or frac fleet that some people use, and then plot those over time. And the period of time was the very same as Dawson Geophysical. Q1 of 19 projected through the last quarter of this year, quarter by quarter by quarter.
Okay. Gotcha.
And one of the things that you find is that if you look at drilling rigs, they were able to generate per quarter about $2.2 million a quarter of revenue back in 19.
Okay.
And now they're able to generate about $3 million a quarter per drilling rig. Frac spreads back, 4 years ago were $18 million.
Oh, wait a minute. The rig numbers were 22 million, not 2.2. Is right?
No,
2.2. Oh, so that's why I'm looking at the right-hand scale.
Yeah, I got scales here.
Gotcha.
So drilling rigs were 2.2 million, and then now they're $3 million per quarter. Gotcha. Got a drilling rig, $3 million.
Okay, interesting. Okay.
The frac spread was $18 million.
Yes.
And now it's $25 million.
Ooh, really? Really?
And the point here was that if you are in the frac business, that now you're generating, $25 million per quarter per frac spread. Quick annualize that, $100 million per year with your frac spread.
Right.
And if a brand new frac spread costs $40 to $50 million, and now you're profitable again. You're 30% EBITDA or something. Some of that can go to build. You can actually go build another frac spread after a year or two of running a frac spread.
Yeah, sure, I gotcha. Right.
But on the drilling rig, a drilling rig now costs $25 to $30 million to build a new one that can drill the modern well.
You just don't have that, and your annual numbers are 7, 6, 7, whatever. Yeah, okay, I got you.
And which part goes to cash? Yeah, sure. So it takes you a couple years of running a frac spread to get enough money to build another frac spread, if that's what you want to do with your money. But a drilling rig is like a decade.
So I understand the difference there. So, but again, the improvement on the frac side is probably driven by efficiency, don't you think? I mean, there's got to be a huge.
It's the addition of proppant back onto the P&L.
But we also know that frac crews work longer. I mean, the 24-hour day is now a 24-hour day as opposed to a 10-hour day, right?
And a drilling rig has always been a 24-hour day.
And if you're paid on a per stage basis or something like that, then so there is an efficiency element that one needs to consider for explaining why the lines have moved as they have. But your larger point about what does it take to generate the cash to go off and afford a new unit is right on point, isn't it? Yep.
I had a ton of debate. Not all 47,000 people who look at this post react, but hundreds do.
Yes.
And again, one of the things you walk away from was people saying, "So when is the next new drilling rig going to be built? When is the next new frac spread going to be built?" And it's you go back to the discipline in the marketplace, which is maybe not.
So independent of what these numbers were, because in the old days, look at this, we're making about you. I need another one, right?
I'd have 50 of them.
Now you have to think longer about what's. I think there is, compared to years past, more awareness of where the cycle is, and making a decision based on my CapEx decision based on where where do we stand in the cycle, the business cycle for the oil patch? Is how much headroom is there for further growth? How long will the cycle last? I mean, there's just a bunch of those kind of things that are key anymore, as opposed to, hey, what's my number in the bank account?
So anyway, we wanted to just throw those three things out. I know we've gone a little longer than our normal 15 minutes, probably, but we wanted to just reintroduce a bunch of topics. We here at Spears Associates are reintroducing the drill down, and will be approximately weekly now. If you do have any questions or comments, or you want to propose a topic that we address, you can always email drilldownshow@gmail.com. I don't know if you're listening to this via our podcast or if you're watching this on YouTube. If you're not on YouTube, you can find us on the YouTube and you can subscribe to it somehow, some way, either through Spears and Associates or do Drill Down Show. You'll find it eventually. But also, I think just pay attention. We've got new episodes in the Drill Down Show 2.0, and I'm looking forward to seeing if you and I can continue to not break into a fist fight during the show.
Well, we'll see. Anyway, thanks so much for joining us this week. This has been the Drill Down Show. I'm John Spears.
And I'm Richard Spears.